Welcome to all of you just joining the webinar now. We'll just give it a minute and wait for everyone to join, and then we'll kick it off. Thanks for joining us on this it's a sunny Wednesday here in Sydney. So thank you for giving us your time over lunchtime. And while everyone's just coming in, feel free to say hello in the chat. Let us know where you're joining in from. We always love to see where we all are from all around Australia. Whether you're calling in from a city or you're more regional, we'd love to hear where you're coming from. We've got some Sydney, it's sunny in Newcastle too, great to hear. Melbourne. Adelaide, we're going all around the states. Great to hear. All right, well, let's get started, and we might have a few more join as we go. I would love to welcome John Winters, who's the co-founder and CEO of Superhero, here with us today, and also John Caulfield from VanEck, who are here to speak to us all about choosing an ETF. I'll let the guys take it away with the content, but you know, when it comes to ETFs, there are hundreds available, and there are great things about ETFs, but it's often difficult to understand the difference between different types of ETFs and which one, you know, might be the one that you would want to invest in. So we're here to give you a bit more insight into the different types of ETFs today. John, if you wouldn't mind sharing our slides for today, and I'll just go through some housekeeping. We would love to hear your questions throughout this webinar. So if you do have a question, feel free to pop it in the Q&A function. Use the chat for any general comments or to say hello. But if you do have questions, please pop it in the Q&A function. I'll be in the background answering some of those as we go, and then we'll also have time for our live Q&A at the end. So we'll reserve some of the questions throughout the webinar for the end at the live Q&A, but feel free as they come up to pop them in that Q&A function as we go. And just a little disclaimer before we get started, that Superhero does not provide financial advice. It considers your personal objectives, financial situation, or particular needs, and all investments carry risk. So please consider carefully before investing. Past performance is not indicative of future performance, and any graphics, charts, and graphs that are shown today are for illustrative purposes only. We will be talking about different types of ETFs today, but just make sure you consider your own financial objectives and values before you do invest. And I will hand it over. Let's get started.
Fantastic. Thanks, Rach, for the fantastic intro, as always. And John, great to have you here. Thanks for giving us your time, and yeah, it'll be great to unpick some of the questions that investors have, and you know, really how to identify ETFs and which ones to invest in. So a few of the things that we're going to go through today, really just the basics around, you know, what ETFs are, how they're made up, what they offer. Some of the differences between various ETFs that are on the market, some of the tools that you can use to work out what you should be investing in, and evaluating the differences between different ETFs, and then we'll move on to how you can actually invest in ETFs via the Superhero platform. So jumping straight in. So John, take us through high level. What is an ETF?
No, I mean, look, essentially an ETF is just a managed fund. And I mean, what that is a collection of stocks or bonds, so securities. So it's like I say, you know, a fund that just has, you know, they range in number, you know, some have as single digits, 7, 8, 9, 10 stocks, others 300, 500. You know, it's really, like I say, a collection of, and it can be, you know, grouped in various ways depending on the type of approach you're looking to take.
So ETFs, I mean, they're hugely popular these days, and rising demand over the last few years. Having that access to a whole range of different shares through effectively one listed share has seen you know, huge growth internationally and here. Do you think it is that the fact that they are that listed share, that they're more popular than, you know, the traditional sort of managed fund? You know, what is the big attraction to ETFs?
Yeah, look, certainly the structural side of it, like you say, where you actually transact, being on the ASX, it's very efficient. You know, people are used to going on and buying an individual share, and you have this kind of instant execution, and it settles T+2. Whereas with managed funds, you're filling out a form, you're posting them off to a manager, you're only getting a response 4 or 5 days later to see how much you've invested and what the price was and that sort of thing. So, you know, having the transparency in terms of both the execution, but also going on to, you know, our website and, you know, what stocks am I holding, what sectors am I exposed to? You know, people have a lot more visibility, and I think that really helps engagement. But then also, you know, the access to international markets, instead of having to go to an overseas exchange and research individual names, you know, you can go to the ASX and buy an international ETF, and you have 300 companies, and you'll know some of them, but you won't necessarily know all. And it, you know, prevents you from having to go and research, you know, every little, you know, name in some obscure exchanges around the world, but you still get, you know, a good country or theme exposure, like you say, with a single transaction.
And it really does give you that broad diversification just by buying one individual share as well.
Yeah, look, I mean, individual shares are quite binary. You know, you can do well, or you can, you know, lose a bit of money. Obviously, owning more is just probably a safer way. And also, when you're building wealth, you know, if people only have X number of dollars to invest, it helps you build a portfolio in a nice diversified way without having to be too concentrated.
So when we think about understanding what we want to get out of an investment, you know, particularly in ETFs, you know, just talk us through how ETFs are typically structured in terms of, you know, benchmarks and what they are intended or designed to do. So, you know, are they designed to track an index? Are they designed to follow a certain group of shares or sector, or give us exposure to a certain theme in the market? Just talk us through that, you know, that makeup and you know, how they're I guess designed to run.
Yeah, well, look, I guess traditionally the term ETF referred to an index tracking fund. So that's, I guess, the plain vanilla, you know, origins of ETFs. There are more active ETFs coming to market now, and we can sort of discuss that probably a bit separately. But, you know, those index tracking products, it really does all come down to the index itself. Now, you will see an Aussie shares ETF from ourselves and from, you know, 3 or 4 other providers, and it'll say Australian shares ETF, and, you know, the name might be similar with a few little tweaks, but it really comes down to the index that each manager is tracking as to exactly which stocks make it into that index, but also how you weight the particular stocks once they're in the index. And obviously that, you know, difference in weighting and exposure gives you very different risk return outcomes. And so understanding that index, you know, like I say, what are the hurdles to get in? How am I weighted? How often do I get rebalanced? You know, all of those things are really key to understanding what your ETF is going to deliver. And like you say, it could be the broad market. You know, I want to just buy the ASX, or I want to buy a sector or a certain style or factor or something like that. So it's really understanding that methodology.
And I guess for newer investors, some of those more complex, you know, systems and processes in rebalancing and keeping in line with the index, those are some of the things that you don't have to worry about as an investor in ETFs as well. You know, you can sort of set and forget, and it's that passive versus active argument that is, you know, an age-old argument when it comes to investing. But, you know, I guess is that sort of index hugging, or, you know, the benchmarking against the market, you know, that it's seen a massive rise over the last few years. Buffett had $1 million bet that he would outperform an active fund manager with just an index tracking ETF or managed fund over, I think it was a 10-year period that he had that bet on. So, is that index or passive investing, is it a fad, or is it here to stay?
Oh, look, index investing is here to stay. I mean, I think it's a nuanced topic as well, where, when people go active, passive, it's, again, like I say, a very blunt argument, because deciding to use an index tracking vehicle or fund is an active decision. The indices themselves, as I mentioned, are evolving. You can be quite specific and quite nuanced around the rules of that index, so you get quite active outcomes. And passive traditionally has meant by the market cap weighted, all odds, something like that. So the biggest company gets the biggest weighting, you buy everything, and you do it cheaply, and you take, like I say, a reasonably simplistic approach, but you're getting diversification and low cost and a few other benefits. But now you can, in the rules of your index, say, I only want stocks that have low leverage, high return on equity. And so there's some of the techniques that active managers use getting wrapped into an index or a passive construct, but you do get something quite different to just benchmark. So, that part of the market, I guess the middle ground is really growing. But, the points that we've got in front of us, is that methodology, supported by research? Is it just a fad? There's obviously a lot of scope for people to just data mine or come up with something. I mean, we could come up with an index. Let's invest in all ASX companies who have a CEO named John. No doubt a very good index, but not exactly backed. Not exactly backed by any sort of research, and I wouldn't be putting the house on that. So understand that index, and whether you're trying to buy the market, that's great. If you're trying to tilt towards a certain size or sector or factor or whatever it may be, it's got to have some sort of academic underpinnings and a long-term investment rationale.
Yeah. And just to go through what an index is, just for some who may not be fully across that. So an index is typically a makeup of shares. In Australia, we've got the ASX 200 index. It's been created by Standard & Poor's and the ASX. It's the top 200 companies. There's a range of rules that set, those companies as the top 200. But there's the top 50, there's the top 20, there's the top 300. The All Ords is the top 500. And then there's rules in between that. When we look at the states, some of the major indices would be the S&P 500 or the NASDAQ.
Yeah.
The Dow Jones, for instance, that's the top 30 industrial companies over there. The index really is determined, or I guess the ETF is really determined based on the index. And you guys set up a new index if you needed to, if you wanted to go into a new sector that was relatively new. Is that how it works? That you can sort of set up that new index, or do you track existing indices?
Oh no, look, it's both. We will, if we're trying to get access to a particular asset class, we'll go and look at the index providers, see what they have in terms of off the shelf. Does it fit, our purpose? Does it give us what we're trying to achieve in terms of those underlying holdings? And if it doesn't, by all means, we engage them. I mean, ESG is a fantastic example where, everyone's got different ideas and rules and thresholds, and we can go to an index provider, which we did for both of our broad ESG products, and say, exclude companies that are involved in fossil fuels, but include companies that are AAA rated. And, you can be, again, very granular in terms of how you, construct those rules to give you what you want.
Yep. Fantastic. When it comes to investing in ETFs, some of the considerations, there's a whole range of different things. We see it in superannuation, we see it in managed funds, and we see it in the ETFs as well. But some of those considerations, and I'll just point out the last one on the list here is brokerage cost. That is definitely a consideration. You're effectively buying a share, so you do need to take those costs into account. Superhero doesn't charge for buying ETFs on the platform. There is a $5 flat fee brokerage fee to sell, So really removing that barrier to entry into ETFs. But what are some of the other costs that you need to consider when you're buying an ETF?
The management cost is the obvious one, and that's basically the fee that an investor would pay to the manager every year, and it's expressed as a proportion of a percent. So, basis points is what they call it. And I mean, those will range from, maybe single digits up to 40, 50, 60 basis points. So that's, 0.5%, 0.6%. And that essentially just comes off the unit price of the fund every day. It's not actually a cash transaction or a fee that investors need to pay, but it's just the management fee. That's generally the headline number that gets quoted and that people do look at first and foremost. Obviously, it is very important, and those fees will vary, depending on the complexity of, the strategy and the index methodology. How much IP is there going into selecting those stocks or those bonds in the ETF? How often is it rebalanced? Which markets does it cover? Emerging markets are, costlier to invest in than the ASX. So all of these things factor into management costs. And then obviously when you come to actually buy, there's the buy-sell spread on screen. And again, that will vary. The Aussie market is the cheapest, and we will be transacting during our business day. And so obviously the ASX is open, and we know the price of the underlying companies, and therefore, that spread is an informed one. If you're buying an overseas focused ETF, even though it's trading on ASX, the US market's closed at the time. So, the market makers who are providing the liquidity, don't know exactly what the price of Apple is at 2:10 this afternoon. So their spread will just compensate for that risk. And I mean, all of those points on that screen would be, what we would call the total cost of ownership. So, they are all important. I would say, don't just pick, the lowest management cost, because it might be a bit of a false economy. If you are paying more in spread or you are paying more in brokerage, your total cost of ownership may end up being more.
And those costs, again, you don't have to worry about them as an investor in terms of actually paying them. They're all built into the price of the ETF, aren't they? So when you're going in, the market's basically factored those prices, those costs into the price of the ETF. You don't get sent an invoice and have to pay every year or so.
No, absolutely not. It's just factored into the unit price.
All right, I guess now we can start getting into different types of ETFs. So maybe just run through some of the different types of ETFs that are available, and particularly some of the ones that you have available at VanEck.
Sure. I mean, look, we'll start with Aussie equities. They've been around the longest, and obviously, probably more choice locally. As you mentioned up front, we have an Australian equities product. It is a broad core strategy, but we haven't just gone ASX 200 or 300. Other providers offer those, but there's obviously concentration risk in the Aussie market. The top 10 make up 40-45% of the market. So essentially, if you allocate to something that's market cap weighted, you are quite concentrated, even if it's in an index. So we've gone equal weight as the way to approach that. And there are around about 100 names in our fund, and each of them therefore, make up around 1% each. So you still own the largest 100 stocks, you just allocate the same proportion to each of them. So again, that's a good example of where, something quite simple, index tracking passive, can give you very different risk return outcomes to just buying the broad market.
Yep.
Obviously, there's sectors available on ASX. Everyone loves a bank and financials and resources and the usual ones. International equities, as I mentioned up front, I think has been quite a strong driver of the ETF market and the ETF take-up, just that access story. And whether it's just being able to invest, in US shares from here, or now it's, emerging markets, China, very specific, again, granular country level allocations that people can make, has really helped.
Some of the data that we've seen on the platform, we offer zero brokerage on US shares now, but the demand for Aussie listed ETFs that give you that broad exposure to the market is actually greater than buying individual US shares because of that simplicity, because you can get that broad diversification through a single investment.
Exactly. And I mean, it can even come down to something as simple as the price that the share trades at. I mean, if something's listed in the US and it's, $500 a share and you've only got $500 to spend, why not buy an ETF that's trading for $10, $20 here and you own 300 stocks? So it can be, like I say, something pretty structural but simple that, makes sense to just take a more diversified approach.
We might jump to the next one, and we've sort of touched on the underlying holdings when we've gone into the various indices and things. But I think one of the important things that we could probably just touch on is the transparency that ETFs bring. So it's not a black box managed fund where you put your money in, you get charged a management fee, but the price goes up or down, but you're not actually sure what you're invested in. ETFs are fully transparent, aren't they?
Yeah, absolutely. I mean, every provider will publish the holdings of every fund on their website every day. You can go to vaneck.com.au, download an Excel spreadsheet. It'll tell you, what percentage we own of every stock in every fund. And people love that look through, obviously compared to active managers where you get quarterly a top 10 in alphabetical order. And, you really aren't too sure exactly what you own. And that doesn't help with the engagement. Whereas, like I said, transparency is certainly something that people, I think, quite value. It keeps them engaged and, make sure that those underlying holdings are giving you what you actually set out to achieve when you first invested.
Yeah. We have touched quite a lot on this slide already, so I might just move on. And if anyone does have any questions, please drop them into the Q&A and we can circle back to it a little later on. Jumping into the Aussie market and just looking broadly, there's thousands of ETFs globally. There's a few hundred ETFs listed in Australia that give you various exposure. But maybe you can just run us through, Aussie ETFs that they give you exposure to the Aussie market.
Yeah, well, I mean, starting with, I guess, the broadest and simplest, like you say, you can cut the Aussie market essentially by size. Let's see, I mean, just to reiterate what we're talking about when we're talking about market cap, that's basically the size of the company or the size of the market. So, something like a BHP or a CBA being the largest company, they therefore make up the largest proportion of an index, which is selecting purely based on size. So you can have the top 300, top 200, and that'll be a size-based criteria. Small and mid caps will just be a slice of that. So, in the Aussie context, again, large cap is basically the largest 50. Mid cap, the medium-sized companies are the next 50, i.e. stocks 51 to 100. And then beyond that, you're getting the smaller names all the way out to the sort of 500 and the small ords. So, like I say, that's the most simplistic, traditional way of cutting markets or indices, and it's done just based on size. If you're big enough, you get in and you're top of the list. Others, sector related. Are you a bank, a financial? Are you a REIT? They then each get assigned into their own particular sector, and you can build an index saying, I just want to choose, Australian REITs, and that's going to be my Aussie property index, and then somebody will offer you an ETF which tracks that particular index.
And you can invest
there. Yeah.
Sorry. No, I was going to ask you about the bottom point. You go.
Yeah. No, I was going to say that. That's the more recent evolution that I keep referring to, and it's trying to be a little more sophisticated around how you select companies and saying, okay, I want certain characteristics from the companies that I own. I mean, we've got high dividend yield and sustainability mentioned there. You're essentially saying, let's pick the highest yielders and group those together in an index. And then, the ETF will give you access to those particular stocks. Or sustainability being pretty topical, we're going to exclude anyone involved in the oil and gas industry, anyone who is selling tobacco, alcohol, munitions, that sort of thing. That's all negative screening, exclusionary. But we're also going to maybe, include or give a higher allocation to companies that maybe rate AAA in certain ESG metrics. So, like I say, there's a lot of
you really can go into the the Aussie market, which is the market that so many people know. We're familiar with Sydney Airport and some of the names on the screen: Commonwealth Bank, Zip, Qantas, Afterpay. It's really going into those names at a bulk level rather than going into the actual individual shares. But also pulling out things like if you did want higher dividend yield, for a newer investor or even some experienced investors to actually go and research all of the higher dividend paying companies and put them into a portfolio. It is a time consuming, it is a difficult process where through an ETF you can go into those specific sectors and get those specific investment objectives through that individual investment.
Yeah, and the index itself, again, going forward, will be reassessing and recutting that list as well. So you don't need to stay on top of that sort of information and keep doing research. The index and then the ETF sort of does that for you.
Now, Apple's market cap is about the same size as the entire ASX listed market collectively. Looking at international, it's a much bigger world out there than Australia. Talk us through the international market when it comes to ETFs and the exposures that you can get, the different the different countries, the different kinds of investments, and I guess the different strategies that you can take into account.
Yeah, I mean, look, it's always wise to diversify, whether it's within Australia or globally. And obviously, Aussie only makes up, I think, 3% of the total opportunity set globally. So having exposure to these international names, like you say, much, much larger companies and a much broader selection of companies makes a lot of sense. And again, you can do that reasonably simply. Do I track the top 100, 500, or do I buy the whole US or whatever it may be?
Yeah.
Country-specific ETFs, I think, are pretty interesting, particularly where people are looking to tap into a thematic that gets spoken about a lot, whether it's Chinese middle class or Indian sort of growth or something like that. These are thematics people understand. They're long-term investors. They know that if you buy and hold for 5, 10, 20 years, you are going to be, like I say, tapping into some structural growth story, whether that's demographics or whether that's consumption or whatever it may be. ETFs are very effective ways of doing that. And I mean, that can be combined with, the sector or thematic ETFs. I mean, we, in September last year, listed video gaming and esports ETF. And I mean, that's, been a fantastic sort of, discussion piece for us over the last year or so. Obviously, with everybody in lockdown and people spending a bit more time at home and gaming and, that sort of thing, that sector's seen a real sort of, leg up. But it's something that's been around for decades and it's going to be around for decades more. So again, it's something really structural, but, people understand it. People understand the concept of, being online and communities online. And, the esports thing is, fascinating when you see, how many people log on to watch virtual concerts and tournaments and prize money now attached. And, like I say, it gives you something quite exciting to, stay abreast of when you're talking about investment markets as well.
And China's an interesting one as well. Obviously, been in the media a lot lately. Some of the bigger names over there, Alibaba, Tencent, some of those big, very well-known, the big tech names of China have come under pressure with some of the regulatory changes. But tapping into that Chinese, I guess, thematic has been a very strong performer over the last, really the last couple of decades. And you always have bumps in the road, but maybe just talk to the China, tapping into that new economy that is really being built there, and how you can get exposure to that.
Yeah, well, look, I mean, I guess there are two different sides of China. The China that people have traditionally had exposure to are, Chinese companies either listed in the US or in Hong Kong, and the Alibabas, Tencents of the world are good examples of that. Those are the names that have actually been, hardest hit more recently, and I think that's a lot to do with the Chinese government trying to really build out their mainland China ecosystem. So that's, A shares that trade in Shanghai and Shenzhen. And those, again, traditionally haven't been accessible to international investors. We actually provide, two ETFs that buy mainland China stocks, China New Economy being one of them. And that basically says, look, you've got to be a technology, a healthcare, a consumer discretionary, or a consumer staples stock, and you've got to be listed in Shanghai or Shenzhen. And that's the new economy thematic that we think will give you, I guess, true China, or the next level of China exposure that people really want. And that's the mainland domestic consumption demand story. And I guess, probably perversely, some of the headwinds that, the listings in the US and Hong Kong have been facing are probably good for the mainland China stocks, because it's really, like I say, the Chinese government trying to draw that investment into China rather than letting these companies go elsewhere and try and raise money in other markets. And they will all adapt, as you say. I mean, there are going to be bumps in the road, and these guys will adapt, but massive companies, massive opportunity set in terms of the consumer, and they'll bounce back.
And it comes back to that accessibility as well. You said, if you said to someone, here's, 2,000 of the top Chinese companies, go and invest there, to get exposure to all of that, you'd be stuck. Like, you'd have no idea, without being on the ground. There's just like, there's, apart from there being an information vacuum, to start researching all of those companies would be very difficult. So yeah, getting access to all of that directly through a single investment is it is the game changer. It's no wonder why it's been so popular.
Yeah.
Sustainability,
Yes.
ESG investing, massive rise in demand over the last few years, and it's only going one direction. Initially started out as not a great performer, but some of these names and the ETFs in this space, they have performed extremely well over recent years, and it doesn't look like they're slowing down. Talk us through how ETFs can be used to get broad exposure to sustainable investing.
Yeah, well, look, there's probably, again, two different angles, and the examples on screen are the broader ESG, all-encompassing approaches. And that's where we're really saying, we want to focus on carbon footprint. We also want to exclude some of those companies that I mentioned earlier that are involved in those industries that we just really don't want to allocate capital to. And that could be tobacco, munitions, and that sort of thing. So those are, I guess, the usual suspects that are excluded. But what we're seeing more and more now is a positive screen. So we're saying, okay, well, you're a tech company. Are you performing better than your peers? Do you have better policies in place? Are you managing risk better than your peers? And the idea there would be, if you're managing risk as a company better than your competitor, you're going to enhance shareholder value going forward. So, over the long term, that should be a value creation strategy to allocate your money towards those sort of names. Like I say, I mean, that's pretty broad. It's, quite subjective, quite specific in terms of what people want. What we found with one of our more recent listings, Global Clean Energy, a very targeted exposure. I mean, that obviously focuses just on the environmental side of things, where people say, look, we understand that, energy production is the primary driver of global warming. I want to specifically allocate my money to those names involved in the renewable space, or any companies that are making solar panels or wind turbines or whatever it may be. So, like I said, that's a very specific, targeted way to allocate money towards something environmentally focused. Or you can take a much broader approach and say, look, I still want Aussie equities, or I still want global equities. but I want to be quite specific around, not owning companies that align with my values. I mean, I think a couple of things to note there. You just got to, again, look at the index that, these funds track, and just make sure you understand what you own. Obviously, none of them are going to own any energy stocks. So, some of the underperformance you might see in a certain period might be because the oil price has gone up. You've got to understand that and be comfortable with that. And by the same token, if you massively overweight technology companies, which have done pretty well, if that reverses, you're going to see the other side of that. So just understand, again, that sort of weighting. What countries, what sectors am I exposed to by applying some of these screens?
Comes back to diversification again, doesn't it?
It does, yeah. I mean, there's
so I guess
the good old core satellite arguments as well. Some of those are probably a bit more core, and like I say, some of these more industry or thematic ETFs are maybe a bit more satellite, and how you size that obviously makes a lot of difference.
So there's a few names here. So a couple of them are from your competitors as well. You did touch on the esports and video gaming. That's a fascinating sector, and seeing the growth in that space as well is quite amazing. But talk us through some of the other thematics, I guess, that you can get. So you're not just going into a broad country-based index. It's actual, an actual theme that's going on in society at the moment.
Yeah, I mean, look, another example would be something like global healthcare. That's, again, something that's structural, and we spoke up front about having sort of investment rationale for these things. I mean, demographics, there's the aging demographic. Emerging markets need to spend more money on healthcare. That's both at a government level and at a private level. Those companies are positioned well to benefit from that for years into the future. So, as an investment rationale, again, you would say that's an industry I want to be exposed to specifically. So, a healthcare ETF, fantastic. I mean, my favorite stat on the video gaming and esports one, just to come back to that, is, we all know about sort of the movie industry and the music industry. In 2019, the video gaming industry was double movies and music combined. So if anyone thinks this is some sort of little, left field industry that's not really firmly entrenched in society, I'd implore you to have a look at some of the names in there. And I mean, it goes all the way from AMD, NVIDIA, the chip makers, semiconductor makers, which again is a separate thematic in its own right, but through the Nintendos and the Activisions and the EA Sports and some of the publishers that we're all aware of as well. So you're getting the full value chain. Their business models are all evolving. You don't just go out and buy, a cartridge and come back in 6 months and buy the next game. These are monthly subscriptions. People are literally paying $5, $10, $20 at a time. And the company's, I guess, revenue outlook based on that change in business model has really changed the scope from an investment perspective as well.
I see some of the app in-app purchase requests from my kids for various games and things to constantly be upgrading and doing different things. So no, if I've learned anything today, it's that's a very interesting fact. I think another really good example that's not on the list is the rise of electrification. It's the rise of battery technology and getting access to I guess that entire theme. It's not a single industry, it's an entire theme. And if you think of battery technology, it's everything from the lithium miners in Western Australia through to cathode makers, through to actual battery producers, whether it's Panasonic or some of these bigger companies in Asia. It does give you that diversified, that broad exposure. I mean, you mentioned Nintendo and Sony as some of the video game I guess companies, but outside of that, I would have no idea what to invest in. And a really good question when you think of electric vehicles as an example. Outside of Tesla, what company next comes to mind? And you sort of got to think about it a bit. Where with this, you you identify the opportunity in the theme or the industry, and you can get that broad exposure without having to do the underlying research.
Yeah, I mean, clean energy is another good example where I guess there's subsectors within that. Do I take a bet on solar or wind or hydro? And, we've had a look at, some of the projections, in recent past, hydroelectric producers were the bulk of the producers in that space. But if you roll forward 10, 20, 30 years, it's going to be much more evenly split across solar, wind, geothermal, hydro. So you don't have to take a bet on a particular technology either. You just say, look, we know the world is moving to more renewable sources, and I'm going to, buy that as a whole.
Jumping into US listed ETFs with Superhero. So this is an interesting one. VanEck has, correct me if I'm wrong, but they probably have the biggest exposure in the US, and you're giving Aussie investors that exposure through the Aussie market as well, which is great access. But there are some other examples over there as well, where you can tap into that autonomous or electric vehicle theme, whether you wanted to buy the entire market. So things that you need to consider when you're buying a US domiciled ETF. I guess it goes into currency, doesn't it? You're taking that bet on currency as well as the actual underlying investments. How do you sort of manage that as an investor in Australia?
Yeah, the currency is obviously pretty important and can swing things either way. I mean, if you are buying, like you said, some of the examples on screen, you would be exposed to that, US dollar, Aussie dollar movement. So just, need to be aware of that. Obviously, if you're buying hedged products locally, that takes it out of the picture. Look, there's also, I guess, a few, again, not to get down a rabbit hole, but some tax implications of owning some overseas vehicles as well. So just, need to be aware of that before you sort of go ahead. But I'm sure that's, something that's probably taken care of by you guys at the platform level as well.
We do try to take care of a lot of that, determining the tax residency, and also working with you on all of the tax reporting as well. For US listed ETFs, just on Superhero, you can do real-time transfers from Aussie dollars to US dollars. So you could set up a Superhero account. You can fund that account real time using Pay ID. You also get a BSB and account number with your Superhero account. You can do real-time transfer into US dollars and then buy the entire US market using your US dollars on your Superhero account, and then that could go into individual shares or US listed ETFs. When we look at ETFs more broadly on the platform, for Aussie ETFs, we've mentioned there's zero brokerage when you buy Aussie ETFs. We do charge $5 when you buy any Aussie listed shares, and we charge $5 when you sell Aussie listed ETFs as well. So what we're really trying to break down that barrier for people to make that first investment or to continually add to their investments for the long term. We don't want to see people, chopping and changing, particularly in the ETFs. That doesn't always make sense. But really dropping that barrier to entry, having zero brokerage to make those long-term investment decisions. You can filter between Aussie and US shares and ETFs on the platform. And just on the Superhero side of things, we don't charge any monthly account fees. There's no other costs. You can set up an account on Superhero free of charge, and you can fund it and buy Aussie listed ETFs free of charge. So there's no cost for you to do that. There is consolidated tax reporting as well. So all of those dividends, franking credits, foreign tax credits, all of that does flow through into a comprehensive report that you can download. And of course, it's simple and easy to use. I think that is the end of the formal presentation. We might jump into a few questions. I'm just mindful of time as well. We've got about 15 minutes left. Rach, do you want to kick off question time?
Thank you so much to both John and John. What a duo. The Johns really giving us some great insight there into the different types of ETFs. And we do have a couple of questions, some that have been asked quite a lot. So I'll just run through a few of those. Firstly, dividends. So we mentioned there both on the high yield side, but I guess generally when it comes to ETFs, do ETFs pay dividends? How does that work? How often are those dividends paid? And what's the difference in a dividend between what might be traditionally a growth ETF versus maybe one that's specifically focused towards yield?
Yeah, well, look, I mean, ETFs do pay dividends. I mean, I think that's the simplest answer. Much like companies, the frequency will vary. Things that are more income focused, like fixed income, some of them will pay monthly. Some of them that are more internationally or growth focused may only pay annually. A lot of them will pay quarterly. So that's probably, the middle ground. And yeah, I mean, look, it'll range. Essentially, the fund will be paying out the dividends that the fund receives from the underlying companies. So if you own the Aussie banks, you're going to see those dividends flow through. If you're buying, something, China related, you're not necessarily buying that for yield. You may only be getting sort of 1% or so per annum. So it really depends. And again, not to sort of hop onto the fact, but it all comes down to the index. It all comes down to what you own. What are the underlying stocks? You can't just sort of say, what does an ETF pay? It's very specific.
Yeah, sure. And the ASX, particularly for ASX, they do publish a list of all of the ETFs that are available, which is great. And there's a bunch of information out there on the internet too that you can find ETFs that are specifically towards yield. I know Market Index is often one that I jump on, and the individual issuers website. So for VanEck ETFs, John, VanEck have got kind of an info page on each one of those ETFs that gives you a bit more information.
Yeah.
Great. The next question, can we buy ETFs for kids on Superhero? John Winters, this one might be for you.
Yeah, sure. So we have recently rolled out minor accounts. So you can go into the profile section of your Superhero account and add a minor account. So that is anyone under 18 years of age. You are the owner of the account though. So you could set one up for your son or daughter. I've got one for all of my kids. I've set it up in their name. So it does have it's in my name with a designation for my children. You can fund that account. There is a BSB and account number, a pay ID for that account as well. It is run completely separate, but you do have access to it through your existing Superhero account. You get all of the dividends paid into there. It is the same fee structure, so zero brokerage on ETFs, $5 for Aussie shares, zero brokerage on all of the US shares and ETFs as well. So it is a full Superhero account, but it is in the name of your child. And then it's really identifying what long-term investments you want to put in there for your kids for years to come.
Great. A bit of a question now, more looking to the future and some alternative asset classes. Crypto ETFs. We've had a question on crypto ETFs. I'd love to hear from both of you, I guess, what you see in this space. John Caulfield, from a VanEck perspective, what are you looking at in that space, and where do you see the future?
Yeah, look, I think it's inevitable. I think as a general rule, the Australian regulator and the Australian exchange are reasonably conservative, and they've taken a bit of a watch and see approach. There are obviously crypto products available elsewhere in the world, and we do offer some of those. But as far as ETF accessibility here, like I said, I think it's a work in progress, but I don't think there's any definitive timelines just yet as to when that may be approved. But we'll certainly keep an eye on that.
Yeah, definitely an interesting market. I think investors are looking for access to that space, but it comes back to the individual shares or the individual crypto versus buying something that is managed by someone else, managing that risk, and certainly managing that diversification. So yeah, I think there's definitely a close eye on what's happening both here and internationally on that space. I think crypto is it is one that we get asked about a lot.
Yeah.
now to a bit more, again, this is a bit more of a specific one, John, on the Superhero side. Can we move or can people move their stocks from another broker to Superhero if they already have shares sitting on another platform, shares or ETFs? How would they move those across if they wanted to?
Yeah, absolutely. So you would be able to move your shares across. There's a broker transfer form on our website. So you can put all of your details in for your broker. You give that form to us. And the way that the industry works is we pass that form over to your existing broker and we pull your shares across into an account here. The process usually takes a few days. It is a paper-based process. We try not to do anything with paper here. We try to make everything digital, but I guess the industry doesn't want this to be a simple process in moving your shares away from someone. So it is paper-based. We do need your signature on that page, but you're able to fill out that form, send it through to us. We do have support, Aussie support, round the clock to manage all of that for you. So you can transfer your shares across from any other platform.
Great, thank you for that, John. One more on the Superhero side of things, and then we'll do one last ETF more generally question. SMSFs with Superhero, so that's self-managed super funds. Can you manage your self-managed super fund through Superhero?
Yeah, so I'll date stamp the response. So we are early September at the moment. We are looking at rolling out self-managed super fund based accounts. So at the moment, you can only sign up in your individual name. We are looking at adding on companies' trusts, self-managed super funds in the very near future. So watch this space. It is something that is widely used across the investment market, and something that we have been working on. I guess the reason why we don't have it yet is we want that to be a completely digital, paperless experience. So we're almost there. It's in the works, and we look forward to bringing it through to our customers in the next couple of months.
Great, thank you for that. And a question for John Caulfield. Now I've just lost it give me 1 second. Where was it?
I might jump in while
you go one.
Okay, you go.
No, you go.
I was just going to say there was a question that threw and said what spreads are used by Superhero. So just on that, we don't create a spread on any securities. We are a facilitator of your order into the stock market. So whether it's in Australia or whether it's in the US, when you send an order through, it gets passed straight into the ASX. So we don't change any prices. We don't add any spreads on. We do charge $5 brokerage on ASX listed shares, $5 when you sell ETFs. Otherwise, it's zero brokerage when you buy ASX listed ETFs and zero brokerage when you buy or sell any US listed securities.
Great, thanks for clarifying that one. And the last question, which we mentioned a little bit when we were talking about exposure to US ETFs, but what is the difference between hedged and unhedged ETFs? There are both of these available on the ASX as well. So what is a hedged versus an unhedged ETF? And how does that, I guess, differentiate to investing directly in a US ETF, for example, on the currency side of things?
Yeah, so if you're investing in an unhedged ETF here, obviously with international underlying, you are exposed to the currencies of those particular stocks. So, I mean, to make it simple, a US ETF, you would be exposed to the movement between Aussie dollar and US dollar. So you're holding an unhedged ETF, the Aussie dollar drops, you actually benefit from that because of the translation back from US dollars to Aussie. If you were to hold a hedged version of that same fund, all that does is take that currency movement out of things. So you're basically saying, regardless of what the currency does, all I'm getting is the performance of the underlying stocks. So obviously that can move both ways. In the example, when the Aussie dollar drops, you don't get that benefit. Yeah. But at the same token, if the Aussie dollar strengthens, you're protected from that as well. So it's really just, do I leave the currency in or do I completely take it out?
Sure. Great. Well, I think we will leave it there for today. Thank you so much to everyone for joining us, and we'll make sure that we've got a recording of this up on YouTube for anyone that wasn't able to join or had to drop off as well. So thank you so much to both John and John, and to all of you for joining, and we'll catch you in our next webinar. We've got a webinar next week on investing in the US market specifically for anyone that's interested. So watch out for that one in our weekly spotlight email as well.
Thanks, John, and thanks, Rach. Cheers, guys.
Thanks so much. Been great.
Bye.